Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's just shy of 8 a.m. Monday morning, June 10th. Our note this week was titled Tale of Two Surveys. Now, before we move on to a brief summary of all that, I wanted to make you aware of a relatively important note, which is at 4 p.m. Eastern today, the full note, Tale of Two Surveys, the paywall will be removed. And we're doing that because we have an introduction of an asset allocation framework in this week's note, and we'd like all of you to have a look at that, get an opportunity to see what being a full paid subscriber would entail. These weekly notes, we had a pretty extensive preview note ahead of last week's employment report to dig through really what's going on in the labor market, which we wrote about in this week's note as well. So please, by all means, have a full read of that note when it comes out this afternoon. As I said, the note was titled Tale of Two Surveys. That's a reference to the big divergence between the household survey when BLS calls up a bunch of households and asks them, do you have a job? Are you working or not? And the establishment survey, which surveys some 119,000 businesses about their employment situations. We've been, digging pretty deeply into the quarterly census of employment and wages, where BLS goes to some 13 million businesses through IRS records and really digs in. And we've been of the mind that small business employment is weaker than the establishment survey would lead you to believe. The pattern this week with the unemployment rate going up was consistent with that, but not conclusive. There was strong growth in foreign-born workers, which is one of the theories about why the establishment survey has been stronger than the household survey. There was also evidence of government employment picking back up, which has been true for quite some time. We know there's lots of government spending going on. That's part of the whole inflation story. And that was evident as well. So we've over the last few weeks rotated back and forth between being our two disruption scenarios. One is that 10s go to 5 and we have a broader risk off. When the Treasury was issuing in the belly of the curve 2 weeks ago, 2s, 5s, and 7s, we had a bit of a scare on that front. We then had concerns about growth, the so-called growth scare. Payroll report and ISM services survey kind of put that issue to bed for now. So we think actually the bigger risk going into this week ahead of CPI, FOMC, and a quarterly refunding, meaning 3s, 10s, and 30s, the bigger risk is the Treasury market moving up in a fairly impulsive way and causing a broader risk off across asset classes, including equities. As I mentioned, the employment survey the employment report did show pretty decent job gains in the establishment survey, but a much weaker household survey. There's some potential seasonal adjustment problems in there. Almost all the declines in employment came in the 16 to 24 age category. Read the note for all the details this afternoon. Wage growth was strong, was the bottom line. So there's just no way the Fed could look at this report. And though they might be inclined towards our view that, in fact, the labor market is weaker than the establishment survey would lead you to believe, with wage growth being firm, there's no way they're in a position to ease, even with the unemployment rate going up and us being on watch for a SOM rule being triggered. As far as the inflation report this week goes, the broader inflation theme is reasonably favorable for the equity market because the volatility of inflation is coming down, but the trend rate we think is going to stay higher. And that was evident in correlation, this wonky chart I have in the background here. If you're going to look at the video on YouTube, you'll see the blue line is correlation. It remains high. That would indicate things like fiscal policy are pushing all prices up. Negative for Treasuries, but most big parts of the corporate sector can deal with 3% inflation just fine, particularly if they have high fixed costs. We then moved on to preview the inflation or the Fed report, which we think is going to be something of a snoozer. The issues that we're concerned about unconventional policy like forward guidance and their balance sheet providing accommodation to the market. We doubt Powell's going to want to discuss at the press conference. We wish he would, but think on balance, it's going to be something of a snoozer. As far as the summary of economic projections, quarterly forecasts go, look at the forecast for Fed funds for this year and next. The longer run forecast could be interesting, but the actual forecast for unemployment, inflation, and all shouldn't really change all that much. So on balance, this press conference is likely to be something of a snoozer. And then dig in on the asset allocation framework. We used a benchmark 60-40 bond indices to calculate portfolio volatility, give you our recommendations. Please have a look at this report and consider becoming a full paid subscriber. Barry Knapp, Ironsides Macro. Have a good week, everyone. Happy Inflation Week. Thanks.